over 2%. Well, the demand for home loans was stronger than expected in February, but the proportion of loans to first home buyers is at the second lowest level on record. According to the ABS, the number of loans granted in February was up 2.3%, seasonally adjusted 52,460. Total housing finance by value lifted by 2.9%. However, loans to first home buyers fell to 12.5%. That is the second lowest level since data commenced in 1991. Now, despite the fall among first home buyers, Commonwealth Bank senior economist John Peters says the figures are further confirmation the recovery in housing construction is well underway. Let's bring in Ryan Felsman from Colonial First Aid Global Asset Management. Ryan, what do you take, if anything, out of these numbers?
Well, James, I think it shows a continuation of the strong housing data that we've seen over the course of the last 12 months. House prices are obviously up about 10.6%, and at the same time, house financing is up 20.4%. Interestingly as well, we saw investor house finance up a solid 32% at the same time. So certainly the RBA is concerned about this, have come out and cautioned investors and speculators about certainly the housing market itself, and certainly this is further confirmation of that. At the same time, we've also seen construction finance increase by about 22.3% over the year, so where that translates into an increase in leverage and housing credit itself, which is currently at 5.8%, will be interesting to see.
Yeah, because the RBA Governor, Glenn Stevens, on a few occasions has basically cautioned that house prices aren't a one-way bet. They don't simply go up and up and up. That's right, yes.
So what we've seen in Perth is house prices rise last year by about 10%, but with the mining investment boom coming off, house prices decelerate there to around 5% annualised. So certainly there is some evidence, of course, that house prices across the country aren't strong or as strong as they were previously, although Sydney and Melbourne continue to lead the way with extraordinarily strong house price appreciation. And if you look at the whole situation in terms of households, household income relative to house prices, in terms of the long-run average, it's about 31% overvalued, or quite significantly high or elevated. So it gives you an example around the affordability issue that we're seeing
Ryan,
as well.
What does that mean? Does that mean people, on average, are committing, 31% of their wage towards paying for a house, paying the mortgage? Is that?
It's more the relativity or the ratio between household income and house price appreciation. So
you've seen a 31% increase over and above the increase seen in earnings.
Correct, in terms of the long-run average. So that goes back to the whole affordability issue that we've seen, of course, with first-home buyers. And one of the things I did note with the Westpac Consumer Confidence data today, of course, is the fact that the time to buy a dwelling fell by 3.9% in April. Now, that's the lowest level since August 2011. And as you probably recall, back in August 2011, interest rates were at 4.75%, which is a lot higher than they are currently at a 53-year low of 2.5%.
Ryan, John Noonan from Thomson Reuters. Good afternoon.
Hi, John. How are you?
Very well, thanks. Now, you hear a lot of anecdotal evidence and reports, et cetera, about foreign buying of Sydney house prices in particular, houses in particular, and China being named Chinese buyers of our property. Is that affecting the high end of the market, or is that having an impact on Sydney house prices, or is it just one-off stuff?
I certainly think it's contributing, John. I mean, as I mentioned, in terms of the investor housing finance number today, up about 30%. Certainly a large proportion of those be overseas investors. We're seeing evidence of Chinese investors. At the same time, in Canada, they've tightened their rules around foreign investment into their property market. So, of course, Chinese investors are looking for alternative yield plays, and Sydney and Melbourne in particular are two of those examples. So certainly I think Chinese investors, and also there's some evidence of North American investors at the same time.
Do you think, though, the RBA, the desire, if you like, to have ongoing increases in the amount of construction activity supersedes concerns over what house prices are doing in Sydney and Melbourne at the moment?
I think that's part of it. Certainly they want to see residential construction increase. We're seeing residential construction of around 185,000, annualised around 200,000. So the RBA will be quite happy with that outcome. But at the same time, building approvals are quite strong, 22% at the same time. So certainly there's a balancing act that needs to occur between house price appreciation, the demand-supply imbalance, but at the same time population growth is very strong too, so that's putting additional pressure on house prices and certainly activity at the same time.
Ryan, one of the things the RBA might not be too happy with is the fact that the Australian dollar is stronger and looking strong. Obviously, in their attempts to rebalance the economy and be less dependent on the peaking mining investment sector, at what level do you think the RBA starts to get worried about the Australian dollar? We're sort of zeroing in on 95 cents, according to a lot of analysts. What do you feel? How do you think they'll feel about that?
Yes, that's interesting, John, in terms of where the Aussie dollar's gone from January. So once they stopped jawboning the currency down from about January, we saw the Aussie dollar up about 6 cents, so it's currently pushing 94 cents. I think if the Aussie dollar heads towards 95, for example, if we get a strong labour market number tomorrow, perhaps, an upside surprise there, and the trade surplus or trade balance for China is stronger than expected, we could see the Aussie dollar conceivably head towards 95, which would lead perhaps to the RBA saying that obviously that the Australian dollar is uncomfortably high again. At this stage you're saying it's high by historical levels, but certainly we'll see what happens in the near future. But the Fed come out with their minutes in the next couple of days, and that may have some impact on the US dollar as well, certainly around tapering and the discussion around interest rates there as well.
Do you think that the breakdown in terms of the correlation of the terms of trade continues to confound the RBA to some degree?
I think so. I mean, the terms of trade has come down, but certainly it's high by historical levels. And at the same time, we've seen interest rate swaps, a 2-year interest rate swap, quite elevated around 3%, so certainly above its 6-month moving average. And also we've seen some developments in China at the same time. Last night we saw the Chinese equity market up quite strongly. There's been talk about insurance mergers in particular. Previously mergers were prohibited, now they're being allowed. And we also saw the official PMI still expansionary at 50.3. There's a stimulus package being mooted as well, so if Chinese growth stabilises around 7.25 to 7.5% for the March quarter, certainly that would be interesting. But the other thing to note as well, I guess, is the whole story around inflation. Perhaps the RBA is allowing the Aussie dollar to increase a little bit because they're concerned about tradable inflation. Tradable inflation rose by 1% last quarter, and that's inflation represented in overseas goods and services. And obviously the Australian dollar fell, which contributed to that uplift. So perhaps with that first quarter number coming out on the 23rd of April, that'll be keenly watched from an Australian dollar perspective too.
A very interesting point, that actually, with the tradable inflation. Look, just before you go, Ryan, putting all these contrasting, if you like, signals that we've got at the moment, where does it put your view on the outlook for rates?
Well, we're still sticking with our view that we think the next move is up, most likely November. Certainly we're seeing outside the housing market and residential construction, we're seeing consumer spending increase. Obviously there's a disconnect between consumer confidence at present and certainly retail sales. Retail sales are up 10 consecutive months, around 5%. At the same time, tourism's at a 13-year high. It's increased by about 9.6% over the last 12 months, driven mainly by short-term arrivals from China. And the whole net export story is still positive too. So that's a positive. But on the other side, as you say, unemployment's at a 10.5-year high. We've seen some evidence that job ads may have bottomed, suggesting that the unemployment rate may peak mid-year. But one of the unknowns, of course, in all this is the budget uncertainty. So how much will the Abbott government and Treasurer Hockey clamp down on spending? Government spending contributes or consists of about 25% of GDP. And if there's a sharp contraction, perhaps, that will have some impact on GDP. And certainly that's feeding through to business confidence and conditions where businesses seem loath to spend and invest while there's some budget uncertainty and domestic demand remains fairly weak.
All right, Ryan Felsman, as always, great to get your thoughts. Thanks very much.
Thanks for your time, James.
Ryan Felsman there from Colonial First Global Asset Management. John, just wanted to get your thoughts on